Hey everyone, what's going on here? It's the last video for Term 3, Year 11 Accounting. We're looking at budgeted reports, so we're looking at doing budgeting using the cash flow statement, using the income statement, and using the balance sheet here. This is an expectation of Year 12. This is an expectation of your upcoming SAC. You should know how all these work, how they all interact. So 17.6 isn't your coursework, so you only really need page 434 or 434 of your textbook. You don't need to do the workbook because I didn't say this is coursework. But if you want to do it for SAC practice, 100% agree you do that. So on the 1st of December 2025, Tiffany Colony started Be True 2, which sells activewear online. Tiffany has provided the following estimates for the first month of operations. Tiffany will contribute $15,000 of her own cash as well as a personal laptop worth $2,500. The laptop is going to be depreciated at $40 per month. Rent of factory space will cost $3,000 plus GST. So that's per month, it looks like, and that's going to be paid on the 1st of December. Shelving cost $11,000 including GST, so $10,000 plus GST, to be paid in cash on the 1st of December 2025. No, that's purchase using a loan from EK Finance. There we go. Monthly interest on the loan will be 3.6% per annum. The shelving will have a useful life of 5 years and a residual value of $2,500. All sales will be made up of cash, and in December 2025 are expected to be $5,000 plus GST. Sales will be marked up 100%, so cost of goods sold will be half the sales. Inventory worth $3,500 plus GST will be purchased on credit, but Tiffany expects purchase returns of $300 plus GST. Tiffany plans to pay the accounts payable every week, leaving $495 owing at the end of December 2025, but they would earn a discount revenue of $60. The following expenses are expected to be advertising $3,500 plus GST. There's an inventory loss of 2% of sales and an administration expense of 5% plus GST. Additionally, Tiffany plans to withdraw $700 cash and $120 worth of inventory during December 2025. So we need to calculate the following four amounts of administration expenses, GST paid, interest expense, and payments to accounts payable. So let's get those numbers in. So we're on 17.6. I have merged them. So budgeted administration expenses is sales plus GST. So what we do is we go 5% of sales plus GST. So when it says 5% of sales plus GST for administration expenses, that is 5% of sales, not sales plus GST, just the sales, and then you add GST on the administration expense. So sales times 5%, that's going to give us, and the sales were 5,000 multiplied by 0.05. That's going to give us 5,000 times 0.05 is 250. And we got to add, and I'm going to put this here, must add 25 GST. And that would, oh, never mind. We'll just do it here. GST on admin plus, and it's going to be 25 plus. So I'll just get rid of that. Perfect. So don't forget, anything we do on cash will be our GST paid. Let's see. GST on admin. So we're expected, there's no inventory loss. Advertising. So we paid advertising plus 340 because it's 3,400. And we're just going to work our way from the top. So the first one is the capital contribution. Not relevant here. Rent will be 300. So rent will be plus 300. Shelving, that's going to be purchased using a loan. So going to receive the cash. So going to receive that cash. And so they've received cash from the loan. So we'll go plus 1,000, and that's GST on shelving. Yep. All sales will be made for cash, so that's GST received, not relevant here. Inventory purchased, that's on credit. We're doing a cash flow, and that's accounts payable, and I think we're good. So let's do our sums here. We see 25 plus 340 plus 300 plus 1,000, 1665. It is indeed 1665. I'm just going to put one thing up. Alright. And then we're going to do budgeted interest expense. So, budgeted interest expense. Well, okay, what is... Sorry, my computer's just deciding... Working might be optional, but we've got budgeted interest expense, so my computer just flipped out there, so that's why there was that marginal delay. Also, calculator. So, payments to accounts payable. So, oh, no, wrong one. Interest expense, sorry. Interest expense first. So, interest expense it's a monthly interest expense, so we need the total amount of 11,000 multiplied by 3.6%. But because that 3.6% is per annum, we need to divide the whole answer by 12. So, or times by 1 over 12. If you want to go that route, that's more than okay. So we go 11,000 multiplied by 0.036 will give us 396, divide by 12, 33. And that is 33. Lovely. Let's delete the excess. Alright, next one, budgeted payments to accounts payable. So this one requires a little bit more. So we need to get our formula up. So we go end equals start plus purchases minus purchase returns minus repayments minus discounts received or discount revenue. So we know the end, if we have a look at one of the dot points, I think it's dot point 2 for, it looks like about dot point 6. Tiffany plans to pay accounts payable at the end of every week, leaving $495 owing at the end of December, but earning a discount revenue of $60. So we know immediately our end is $495. Then we just need our start, purchases, purchase returns, repayments, and discounts received, which we got was $60. So let's go through the rest of the numbers. So we have a look. We can see that the dot point above, inventory worth $3,500 plus GST will be purchased on credit, but there is going to be a purchase return of $300 plus GST. So purchase return includes our GST, $330. So we go $330. We know we made a purchase of $3,500 plus $350, $3,850. And then our start is 0 because it's a new business. So let's just put our numbers in. So 495 equals 385. Oh, 3850 minus 330 minus 60 is 3460 minus X. we transposition the formula. It'll be, if we plus x to both sides and minus 495 from both sides, it becomes x equals 3460 minus 495. And that accounts payable will be, and that's x by the way, 3460 minus 495 will give us 2965. Again, 2965. So let's chuck our numbers in. All right, we're gonna create a new page. So first things first, let's get our textbook up and let's get the cash sales. Or we'll just go dot point by dot point. We'll make sure we do inflow first. So dot point 1, Tiffany will contribute 1,400 or 15,000 of her own cash. That is financing. So you say capital contribution 15,000. We don't include the personal laptop because that's not cash. Rent a factory, that's going to cost money. We're going to go to sales, and we're going to go, okay, sales was the other big inflow. We see cash sales is 5,000. GST received is 500. And we can just go straight away. Whoa, sorry, just moving my textbook around. Lovely. And we see that is straight 5,500. Next we tick over to, we're going to start doing our outflows. So we work from the top. We're going to go rent expense, or rent, yeah, we'll just call it rent expense. And that is 3,000. Make sure you put it in brackets because it is indeed an outflow. So we've got rent expense. Shelving is going to be investing. So let's put shelving 1. And remember, we take out the GST, so it's 10,000. We've done sales. Inventory is done on credits. Payments to accounts payable. And we see that was 2965. We go interest expense is 33. I'm just getting these from the previous question, by the way. We've got payment to accounts receivable, interest expense, administration expense. You can call budget administration expense, but I just call it administration expense. And that will be 250 in brackets, always brackets. And we just keep working our way down. We also have advertising. We see advertising is 3,400 and GST paid. So we have a look at GST paid, 1,665. There we go. That looks like it is everything. Let's do a quick subtotal. Double check we've got all the numbers. And we see it's 11,313. And it's a bracket. And we can see right off the bat, not a good start. We can see that right off the bat. And we see shelving, 10,000. Now, because we did pay for shelving, it is in brackets. We got capital contribution. We do have the loan from EK Finance, which, if we remember from the question, they used that to pay for shelving. So that's an inflow of 11,000. Then we look at outflows, and we can see that Hold on. Just decide to blow up another part of my computer. All right, so we got loan 11,000. There was no mention of repayments. So they only had the interest. They didn't have anything on repayments. Did they have anything on repayments? Monthly interest. Yeah, it doesn't mention anything on the repayments. But I'm assuming maybe, I'd say they're probably monthly as well, if that's the case. Monthly interest is 3.6. Doesn't mention anything about a loan repayment, which is sufficiently odd unless I have a look. So shelving, loan, unless it's 2,500. That could be it. So 2,000 divided by 12. Nope. Okay, it's not that. Sorry, I'm just trying to figure out where they get this number from. So 11,000. Sorry, I'm just going 11,000 divide by 5 divide by 12. No. They haven't given us... That's so weird. They have not given us that. It's 3.6. Yep, no mention of that loan, so we're just gonna go with what they've given us. So, okay. Let's just keep going, and then drawings, and we'll put the brackets there, and that was 700 in cash, and that is 26,000. Now we just need to do our subtotals. We'll do the easy ones first. So we know that's 10,000. We know that's 25,300. We know those numbers. We know the starting bank balance was 0. So we can just move that there. So the only one we need to calculate is 5,500 minus 11313, 5813. 5813, and then we just go minus 10,000 plus 25,300, 9487 plus 0, 9487. The way I got 0, by the way, is because I start the business. Obviously, bank account is 0. So let's do our shelving depreciation. So it is going to be, where was it? Useful life of 5 years. So we want HC minus residual over useful life. So, and then we got to do a double bracket. Hooray. And then we divide that whole answer by 12, because it's for 1 month, we're doing it for the whole year. So historical cost was 10,000. The useful or the residual amount was 2,500 divided by the useful life of 5 years, divide by 12. So we end up with 10,000 minus 2,500 divide by 5 gives us 1,500. So that's 1,500 divided by 12 gives us 125. So that gives us 125. So let's put all our numbers in. So we're going to work from the top again. We go sales to start. That's 5,000. Now we know markup is cost price times 1 plus markup percentage, and that's where you get selling price. So if we change that, it's cost price is selling price divided by 1 plus markup. If it's 100% markup, so it's 1 plus 1. So it becomes 5,000 divided by 2. And the gross profit's going to be 2,500. Then we go less inventory loss, and we see what's our inventory loss. They go 2% of sales. So we go 5,000 times 0.02 is 100. That means the adjusted gross profit becomes 2,400. And then we go discount revenue. And our discount revenue, if you have a look at the 2, 4, 6, 7th dot, 6 dot point? Yep, 6 dot point. You can see at the end they earned a discount revenue of $60. So it becomes 2,460. Then we've got less our other expenses, and we just need to start with the cash flow statement. I think that's always the easy one. So rent expense will be 3,000. So that's our first little starting point. Rent expense 3,000, interest expense 33. So let's get those on there. Yep. So we got rent expense 3,000. We also have interest expense and administration expense. Interest expense, and that came. I'm just going to zoom out just so I can see a touch clearer. To 33, and admin expense 250. I'm just going to put that in there now, and we'll zoom that back in just so it's a touch bigger. So that's our administration expense. That's our interest expense. We had advertising, which was one of the dot points in that group of part of inventory, administration, so on. That's 3,400. Don't need to do any special calcs there. Now, there's 2 more. We've missed depreciation of laptop. And that's $40 per month. The other depreciation we calculated here of shelving. And that's 125. So let's put those numbers through. So 3,000 plus 33 plus 250 plus 3,400 plus 40 plus 125. We see it's 6,848. And we can see we've made a net loss for the period. So 2,460 minus answer will give us a loss of 4,388. So there's our profit figure for the period. Now we're going to do some quick theory. We need to explain why this has occurred. So E, identify 2 reasons why. B2 true is expecting to suffer a net decrease in cash despite earning a net profit. Pardon? They earned a cash surplus, and they had a cash surplus, or they didn't have a cash surplus. They had a cash. No, they did have a cash surplus of. What was it? A cash surplus of $9,000. So, sure. Not sure where they're pulling these numbers out from, but here we are. Yeah, that cash surplus, and the thing's just like, nah, we're not going to get this to work. Weird. Strange. But anyway, the question, we're going to reframe it. Why did they have a cash surplus instead of having and not have a net profit? So, reason for cash surplus and not a net profit. First one I'm going to go with, And the most obvious, capital contribution, because that makes cash go up, doesn't negatively impact our doesn't impact our income statement in any way. Another reason I'm going to pick out is cost of goods sold, but you can pick out any expense on here that doesn't appear on the cash flow statement, so depreciation or cost of sales. So you can pick any of those. You could talk about the loan, so you got a few different options there. But the general crux is you need to be explaining loan, cost of sales, depreciation. How to answer, you want to say why cash went up or profit went down, and then how this had no impact on the income statement if using cash, or on the cash flow statement if using expenses. So you got to pick out, if you pick expenses, you got to go, okay, this is why the profit went down because it's an expense, but it doesn't impact cash. That's essentially how you're explaining that. So just refer back to the table we did last, or this term. If you're watching it later on, it's last term. So budgeted inventory. So let's get our inventory formula up. So we want to go start. So we want to get the end amount. So we go end, and we don't have it. So we go start plus, plus, were there any pluses? Nope, no sales returns. So we get start plus purchases minus cost of goods sold minus purchase returns. I believe those were the only numbers we had. So our start was 0. Our purchases, if we go back, we see was 3500. Then we minus, oh, I forgot inventory loss. I'll add that in there. So we see cost of goods sold was half our sales. So we just go look at cost of goods sold again. It was 2,500. Then we had purchase returns of, there was purchase returns of 300. And we had an inventory loss, if we go back up, of 100. So we just need to put that through the calculator. Or have I missed something? Look at that last dot point. Tiffany plans to withdraw $700 in cash and $120 in inventory. So that's going to make our inventory go down as well. So let's keep going. So I'm not going to go through 0 plus. I'm just going to go 3,500 minus 2,500 minus 300 minus 100 minus 120. $480 worth of inventory. 480. Woohoo. So if we do our balance sheet, the first thing we're going to put is bank. But the second one I'm going to put is inventory, because I've already got the inventory amount. I already know what it is. Okay. That is the third time that's actually happened to me today. Just that little thing where I drag it up. So we see inventory 480. Let's start with 480. Boom, it's sorted. Let's go to bank. We'll do our GST payable receivable. So the end equals start plus cash GST in plus, there were no credit sales, so I can just ignore that. But I have to add purchase returns because that means we get GST back. Please remember that, because we get the inventory and the GST back. And then we minus, then we go GST paid in cash minus GST paid in credit. So our start's 0. Our GST paid in cash, if we go to the cash flow statement, was 500. I'm also going to remember 1665, okay? So it's 0 plus 500 minus the GST paying cash, 1165. Now we've got to look at our purchase returns. So we have a look at, again, we see Tiffany expects purchase returns of 300 plus GST. So we just got to add 30 GST. So that's GST, that's our cash. And our GST paid in credit was 350. So we see we get our final answer of, and remember, if it's a negative, it's a receivable. So we go 500 minus 1665 minus 350 plus the 30. 1485. 1485, that's in brackets. So it's a receivable. Make sure you put that in there as well. GST receivable 148. Oh, geez. 1485. Now we just need our bank. And our bank was 9487. We get that from the accounts payable. All right. We're going to do our non-current assets. So if we have a look at the start. So we have a look at the start. We go, okay, what do they owe, or what's happened here? So non-current assets, we see that a laptop was given to the business. So that's laptop. We go by the historical cost, 2,500. Less ACDEPN. And the accumulated depreciation for the month was, from the income statement, $40. And that becomes 2460. And then we rinse and repeat for the shelving, and that's 10,000. And then we go less ACDEPN again. And we smash that out. That less accumulated depreciation will also be in the same spot, and it happens to be 125, and that becomes 9875. So those are all our assets. We've only got one current liability, which is accounts payable. Like, having a look through, a lot of the other stuff's all expenses, which we've already accounted for. We see the accounts payable is 495. Because it's the only one, we can just put it there. Then we've got a loan from EK Finance. Now, there is no mention in my book about how much is due immediately. So we make the assumption that if nothing's mentioned, it all goes at the non-current, because it means it doesn't have a due date. And they've given nothing to say this is how much they're paying for at the start. So we go capital, and we got the owner, which is Connolly. Connolly, 0. And we add capital contribution. We less drawings. And we less... Or we... less loss. So our capital contribution, if we have a look, it's the first one, was 15,000 cash plus the laptop is 17,500. We see the drawings were 820, which gives us a total of 17500 minus 820. I'm not going to add the 0, but you got to have the 0 at the start so you know it's a new business. It's 16,680. And then we've got the loss, and the loss is, and that should be less loss. That should be net loss, by the way. Well, I don't know why they put that in brackets. And then we less net loss, and that will be, I fixed it, but 4388. Make sure you put the word loss. You don't need to add profit, I don't think, unless you want to go add net profit, but I think less net loss is probably the better choice, because it gives a more, you can just look through and go, oh yeah, it's a net loss, cool. So 16680 minus 4388. 12292. 12292. And then we need to just do a quick addition over this side. 9487 plus 480 plus 1485 is 11452. 11452 plus 2460 plus 9875. 23787. 23787. Now we're just going to go minus 12292 minus 11,000. If I've done this right, 495 will be our accounts payable. We can double check it as well. Going 495 plus 11,000 plus 12292. Damn it! Let's do it again. 495 plus 1100 plus 12292. I pressed space. I shouldn't be pressing space. Alright. The space hands up here. 23787. We got it. Now I can hit space. Alright. And that is how you do the whole budgeted report. Thank you for watching along. I do encourage you, if you do find this a bit fast, to pause video, go back. I am, hopefully there are timestamps and all that you do follow, so you can just click on the different ones. Again, thank you for following along. Make sure to like the channel, because there is more accounting stuff on there that hopefully grabs your interest. So on that Nate, who's Nate? I don't know any Nathans. But on that note, I will see you next time.